Alrighty, welcome back to another episode of The Upside with Eli. I'm joined again today with Brandon the Murph Murphy. Welcome to the pod.
Back in the pod. Here we go.
Yeah, and we were just chatting before we started. You had a nice little morning, I guess, or early afternoon. You had a client go through a full audit, came out squeaky clean.
Yeah, 3-year CRA audit. No reassessment or nothing. Came out clean, and yeah, chatted with another client today and looking to gift a bunch of money to her kids. Lots of that excess wealth, like we were chatting about last time. So
sweet.
Everybody's happy today.
And CRA for this one, they drove all the way from Vancouver. They thought they were going to find something. There was nothing to find.
They thought they had gold up in northern BC, but there's nothing there to see.
Yeah, right on. Well, that's good. But we like to hear those stories. Obviously, it's frustrating when CRA tries to go after people for no reason. But it happens, and it's just nice to people can get that off their back. It's good.
Yeah, keeps everybody in check.
That's right. Today we've got kind of a slightly different format of what we're going to talk about. We got a list of questions that people have kind of sent in, and we're going to kind of go back and forth and kind of answer questions. And for anybody who has more questions for either myself or Murph, add them in the comments, and we will get through them on the next episode.
Totally.
Right on. Cool. So number one here on our list, I heard that you can unlock LIRA and transfer. Actually, sorry, which way are we going to do this? Are you going to go through those ones or am I?
Sure. How about I'll ask you, and then you can ask me the questions from your clients.
Okay, so that's good. Let's do it that way.
Yeah. So I heard you can unlock a LIRA and transfer a portion into an RRSP. How does this work, and why would anyone actually want to do this?
Yeah, so for people who aren't familiar with it, locked-in retirement accounts are when you had, either a defined contribution pension at an employer or you had a defined benefit pension and you took a commuted value. It's going to roll into a locked-in retirement account. And each province deals with them slightly differently. And then there's also federal pension jurisdictions that will determine some of the rules. And in many provinces, what happens is when you go to convert that LIRA over to a LIF, a life income fund, just like you convert an RRSP over to a RIF, when you make that conversion, you can do a one-time election to unlock 50% and roll it into your RRSP. Now, that doesn't exist in every province. In some provinces, it's only 25%. But generally speaking, we just use as a rule of thumb, you can unlock that 50% when you do that conversion. Now, there's not necessarily a huge advantage to it unless you want to be able to draw that money down faster, but there's no disadvantage to doing it. So a lot of people will never actually take advantage of the fact that they got to, do that conversion. But let's say you have a reduced life expectancy or you just need to access more money in your early retirement because you want to travel more or do more fun things, you have the ability to, access that money, pull it out. Whereas in a LIRA, you have a maximum amount of money you can withdraw in a particular year.
Yeah, exactly. That's what I tell people as well. It just creates that flexibility. Like if you roll everything into a LIF, you have that band there of a minimum and a maximum withdrawal. It's like if you can create that flexibility where now you can make a large withdrawal in 1 year for whatever reason, take that trip, you're making a purchase, you might as well access that flexibility.
Totally. And federally regulated, or like federal pension jurisdiction is kind of unique because you can actually roll it back if you've already converted over to that LIF. And none of the provincial ones allow that. But we had a client once who their advisor just didn't do that unlocking. And so we were actually able to move it back from a LIF to a LIRA and then do a LIRA back to a LIF just so they could do that 50% unlocking. And it just so happened that it was a federal pension. So we were able to do that, which was slick.
Oh, that's interesting. So you unlocked it, then you moved the 50% back over to their RRSP as well.
Yeah. So because they hadn't done that unlocking the first time. So the advisor missed that.
Oh, there you go. Good thing to pick up on.
Yeah. Made us look good anyway. All right, number 2 here. We just had a client sell their business and pay an extra $200,000 in alternative minimum tax. Woohoo, big win. Why does AMT exist?
$200,000 in tax. No one likes writing that check over to CRA. AMT, alternative minimum tax, it's there so that basically people aren't abusing the Tax Act through preferential tax treatment.
But is it really abuse?
The thing is it's usually driven by one-time transactions. No one is purposely doing these things. Generally, no one's purposely putting themselves in a situation where they have to pay AMT. It's oftentimes things like you sell a business, so you've got your capital gains deduction. Maybe you've got a large charitable donation in 1 year that can again trigger AMT. Maybe you're investing in something that's just very tax efficient, like flow through shares can sometimes generate AMT as well. And effectively, what's happening there is you have this transaction that it's a taxable event, it's a liquidity event, but there's some sort of offsetting deduction, some sort of offsetting credit. So you look at a sale of a business, for example, you sell for $5 million, but then you're also using your lifetime capital gains exemption of 1.27 right now million. That capital gains deduction is lowering your taxable income, but your net income is still up at that 5 million. So what that AMT calculation is essentially doing, very complex calculation. We don't want to walk through the 20 pages that it is in a tax return, but it's recalculating to say, are you paying your minimum tax at 20.5% in the year?
Yep.
If not, you're going to have to pick up some of that alternative minimum tax. You pay it in the current year. The benefit is you can carry that forward for up to 7 years. And
I wouldn't even call it that. I'd say the saving grace is we can recover that over the next 7 years. But and unfortunately, they'd raised AMT recently, right? So it used to be 15%. Now it's that 20.5%. And there's like you say, there's a fairly nuanced calculation there. But to this person's question of like, why does AMT exist? You're basically being penalized for using the Tax Act as it's intended to be used, right? To pay a certain amount. And you hit the nail on the head is it's not nobody's paying AMT every year. It's these one-off events. And it's frustrating because usually those are like once in a lifetime events for a lot of people. And then all of a sudden they're all excited because they've, just got this huge windfall. And then all of a sudden it's like, okay, I was not expecting that extra $200, $300, $400, $1 million, kind of tax bill. I would say most common AMT amounts we've seen, and you've probably got some numbers too, but it's usually in that few $100,000 range because I would say it's the additional taxes from using the lifetime capital gains exemption, and that's, correct me if I'm wrong in your experience, but that's usually a big surprise to a lot of people. Yeah,
absolutely. They think lifetime capital gains exemption, I'm all tax sheltered, but if you don't have a lot of other income, you might get caught in AMT. And to your point, it is silly. You pay that tax in 1 year. Likely that money's going into investment accounts. Maybe you have other earnings in future years. You're going to recover all that tax. Now you're just caught doing that calculation every year for multiple years just to recover all that tax again.
Yeah. Yeah, and some people can't recover it, right, if they don't have income. But generally speaking, we can recover it. We obviously want to recover it, as quickly as possible. And I'm gonna jump ahead of you on this next one because this next question is very much related to that. It's why would you avoid making RSP contributions if you're trying to recover AMT?
Yeah, that's a good question. I think if you're looking to recover AMT, we got to think in future years when we have that carry forward amount of the AMT that we've paid in the current year, we want to ensure we have enough income in future years to claim that, to recover that AMT. If you have RRSP deductions, sizable RRSP deductions, you might be using your RRSP deduction instead of recovering your AMT. Now, there's a difference between your RRSP deduction and your RRSP contribution. You could make your RRSP contribution in the current year, and then you get that tax shelter growth in the account.
Yeah.
And then just take that deduction in future years after you've recovered your AMT.
Totally. You might as well, if you have the room available, use it, get the sheltering moving in your favor, knowing that you're going to make contributions, use deductions at some point, but just carry forward that deduction. I think one, you got to be a little bit careful because sometimes, if you're not filing your tax, you're not openly communicating with your accountant, they might just automatically, use that deduction of the year. So you have to have those open lines of communication. But I see that in a lot of cases where that's just a massively underutilized strategy of making that contribution, but carrying forward the deduction.
Yeah, exactly. And I was actually just working with a client that sold a business and we ran out like a current scenario of today, but then we're also considering what's their RRSP withdrawal or your RIF withdrawal income going to be in the future. Can you split that income with a spouse is always a big question. And there are times where that RRSP balance gets too big and maybe it doesn't make sense. Maybe that tax deduction today or after you recover your AMT just doesn't make sense relative to what your income's going to be in retirement. That's why it's good to look at a 5 or 10 year horizon and not just point in time.
Totally. Yep. No, 100%.
Yeah.
Cool. What's your next question on there?
Next one. Oh, this is a fun one that I had come in on one of my social media accounts. I think it was TikTok. I was told 15 years ago that I need $3 million to retire when I was applying for overdraft at my bank. Is this true that you need $3 million to retire?
And yeah, I mean, ultimately, it's going to depend, on the specifics of your situation. We'll see a lot of clients who there's no way they could retire on $3 million, and we'll see a lot of clients who that's more money than they could ever possibly spend in their lifetime, based on their lifestyle, right? So, if you're going in there and you're applying for overdraft protection, maybe you've got a spending issue. Maybe there's other reasons to have overdraft protection, but it really is going to come down. I think most people underestimate how much they actually get when you get CPP and OAS, especially for a couple who say retires at 65. You're potentially getting in that $4,000 or $5,000 a month range just from your government pensions if you're maximizing those out. Now, if you have an extra $1 million on top of that, or maybe a DB pension, or you've got some RSPs or different things, right? It doesn't take a whole lot to have, what we would consider like a comfortable, retirement. Now, that being said, most people aren't striving. I shouldn't say a lot of people aren't striving for just comfortable. They want to, have a great lifestyle. They want to travel. They want to have a vacation property. They want to do those things. You might need well in excess of $3 million, but I would say for the average Canadian, you definitely do not need, $3 million for a typical, kind of retirement.
Yeah, for a comfortable retirement. And it really does depend. As you know, we talk to vastly different people where spending is anywhere from X to Y on that threshold. And I do always get a chuckle when you see those articles come out. It's like Canadians need 1.5 or they need 1.2 million to retire. And it's like, really depends what you want. Depends what other income you have coming in. Because you might have someone with a very strong DB pension and now they're reading that article stressed out thinking, I need another 1.5 on top of my DB pension. It's like, no, you're probably comfortable with what that is going to supply.
Oh yeah, your DB pension probably has a commuted value of like a million or 1.5 million. People don't factor that in. And there's lots of people. We have clients that live very comfortably on like $70,000, $80,000, $90,000 a year. They have no debts, right? And they travel and they do these things and they're sitting on more money. They just don't even end up spending it. They don't need it, right? Because they're already kind of living comfortably. So yeah, but there's a lot of that fear mongering in terms of like, okay, you need this massive portfolio, and for the average Canadian, just not necessary.
Yeah, you can probably be comfortable on less, let alone this was 15 years ago. So
that's fair. If that was 15 years ago,
2010, $3 million, that's going to get you pretty good retirement.
Yeah, I mean, if inflation keeps up the way it's going, maybe you will need that money 15 years from now. But that, obviously it's all relative. Alrighty, next question. My friend told me I shouldn't use RSPs to offset the sale of the tax owing when you sell a business because his income will be higher when he's retired. So I'm assuming this is a liquidity event. You've got a large payout. You're going to be in a high tax bracket. Is it dumb to put money into RSPs?
Always depends. Honestly, great question, because I was just working through a scenario exactly like this with a client where they sold their business, and I think I touched on it a little bit. And this just goes back to, you don't want to just look at point in time, like, oh, what's that RSP deduction worth today? You do want to consider what's their RSP going to balance going to be in the future. What other income sources are they going to have in retirement? If now you have a large non-registered investment portfolio, you've got CPP, you've got OAS coming in. If OAS is still a factor, if you have pension coming in, then potentially RRSP is not the best option, because maybe you're just in the same tax bracket now as you will be 3 years from now when you retire.
Yeah.
And then in the situation or the scenario I ran for a client, we kind of met in the middle on this one. We made an RRSP contribution that they could then deduct over the next 2 years. So as part of his agreement in the sale, he was going to continue working for an additional 2 years just as part of the transition period. So make that contribution today, deduct it over a 2-year period. but not all of it, because we ran the projection out after that. He's going to be retired. Now he's going to have a non-registered portfolio. He's got other income sources coming in. It didn't make sense for him to put the entire proceeds into his RRSP. He wasn't going to be able to use the deduction.
Yeah.
And he was just going to be in a high tax bracket in retirement anyways. I was just thinking another factor on this one is, do you have a spouse? That RRSP deduction is probably going to be great today. And then once you get into retirement, do a RIF conversion. Now you can split income with the other spouse, equalize your household tax rate. Now you're dropping that tax rate. You may be in a 48% bracket in Alberta. Maybe you're down in 25, 30% bracket between you and your spouse.
Yep. Yeah, makes perfect sense to me. Next question.
I think I'm on the next question.
Oh yeah, next one's you. Giver.
Are we on? Yeah, we're on 3 here. I saw an advisor say it's a mistake to increase your mortgage payments if you still have RRSP and TFSA room. Is that true for someone in their 50s?
Yeah, so it's interesting because they're phrasing this question as somebody in their 50s. I don't, there's the side of it's like, yeah, pay down debt, right? You should pay down debt. But there's the also side of the math that says, if you're going to earn more money on your investment, this is my opinion. If you're going to earn more money on your investments, net after tax, right, then you're going to pay an interest, right? You should be investing that money. And the whole idea is that because everything is tax sheltered, right, within your TFSA, within your RSP, when you contribute to an RSP, you're also going to get a tax deduction, which can be reinvested into a TFSA or wherever, right? You're going to be further ahead, especially with current mortgage rates. Even though they're slightly higher than they used to be, they're still low, relative to markets over long periods of time.
Terms, yeah.
And 50 is not that old, You might still have another 30, 40 years, kind of market growth on that. And so it kind of becomes the question of what's more important to you, cash flow or net worth, right? What are you trying to maximize? Because if you're trying to maximize cash flow now, you don't necessarily need to put away that money because now you're going to be out that money. But if you're trying to maximize your net worth, absolutely invest that money, especially if you have that room available. If you don't have that room, there's a slightly more nuanced calculation because you have to figure out, okay, if I invest that money, but now I got to pay taxes on it, am I still ahead of what I'd be, saving in interest costs? For a lot of people, if your mortgage is still like 3-4%, the answer is still yes. But it also depends on the risk tolerance of yourself as an individual and how much of your portfolio is in, kind of more, I guess, equity or capital gains bearing investments as well, and what kind of a rate of return you're getting. So my opinion is always, max out RSPs, TFSAs before that, but there's always going to be nuanced situations.
Yeah, exactly. And as an advisor, I tell people it's my responsibility to run the math or provide my financial opinion to you. We work with a lot of people that they have that behavioral response to debt and carrying a mortgage. And I've seen people, they get a severance payout or a large bonus. And I'm just like, the grass feels greener under my feet if I just repay the mortgage and get it out of the way. And I'm like, that's totally fine. I'm like, I'm not going to stop you. And they almost have a little anxiety coming to me to tell me that because they're like, oh, Murph's not going to like this one.
Yeah. And they just assume that we're always going to be that way. But at the end of the day, there's so much of financial planning is psychological. And you got to do what you feel comfortable with. And I always ask people, how do you feel about debt, right? On one hand, people say, I hate debt. I just want to get it gone, as quickly as I can. It just stresses me out having it. And on the other hand, there you get people that are like, oh, I'm okay with debt as long as it's constructive. It's not, consumer debt at a high, really high interest rate. And most people are fairly comfortable with debt when it's, kind of constructive and when you can show them the math. But you're going to run into people that are just like, Eli, I don't care. I just want that gone. I don't want to have to pay the mortgage. I just don't want to dealt with anymore, and that's cool too. Right? There's no perfect answer, right? It's not always about maximizing every last dollar. You got to be able to sleep at night too.
Yeah, exactly. We just want clients to be comfortable with whatever decision they made at the end of the day.
Yep. Number 4 here, is there still value to spousal RRSPs? So something we don't talk about too much anymore. Why do people still use spousal RRSPs?
Why are we using spousal RRSPs? That is a good question. And when it comes down to spousal RRSPs, a lot of it has to do with retirement age, your goal of when you want to retire. So if we look at just RRSPs in general, standard age 65 retirement, it doesn't have as much value because once you turn 65, Now you can start splitting all that income. If it's structured properly, you roll some RSP into a RIF and you can split that income amongst your household.
Which didn't used to exist. And that's when spousal RSPs came out for those of you who are listening. That wasn't always the case, but it is the case now.
Yeah, exactly. So now it's the question is, does spousal RSP make sense? And it can still have its place for people that want to retire before age 65, because if you retire at, we'll use 55 as an example, there's just not many income splitting opportunities unless you have a DB pension coming in there. So spousal RSPs can make sense to balance out those accounts between you and your spouse. So for everyone listening, if you are the higher income earner and you make a contribution to your spouse's RRSP, a spousal RRSP, you're getting the tax deduction in your high tax bracket. They get all the growth in the account, and then they're going to draw that income out in retirement in a lower tax bracket, hopefully a lower tax bracket if you're running the numbers properly.
Yep.
And that's where the benefit can come in, as you try to equalize those balances. You retire at 55 so that over the next 10 years, you can draw systematically from both of those accounts. And now you don't have one spouse that's in a 48% bracket and the other spouse that's in a 20% bracket.
Totally. And I think it makes a huge difference too, especially if we're trying to get more money out of RSPs, kind of earlier on, which is for a lot of people who retire younger, they might have large RRSP balances, but they've got maybe large non-registered portfolios or different things. There's a reason why they can afford to, kind of retire earlier. And so the ability to kind of do a bit of that RIF meltdown and kind of draw more out, the ability to income split that, it just exacerbates, it makes the issue a lot less, it doesn't cost people nearly as much money, right? When you can split that out properly. Yeah,
exactly. And another big factor there is, CPP is going to kick in at 65, or if you defer to 65 or even later, OAS is coming down the road. So it can make sense to draw down those balances more quickly so that there's not as much there.
And I'm definitely finding people are starting to do that more and more. I mean, especially with you read so many articles about get money out of RSPs. I think some people kind of overblow it a little bit and they start getting out too aggressively and want to just pull everything out as a lump sum. It's just as bad as passing away with a large RSP when you do it that way. But yeah, I think, starting to draw that down and spread that tax liability out over a longer period of time just makes sense. And there's some nuances obviously when you have spouses who there's a big kind of age gap there that we can kind of play around with. But I agree with you. Like, I think spousal RSPs still make a ton of sense to just keep those balances equalized.
Yeah, exactly. I always say it's better to pay a little bit of tax every year throughout retirement than leave a big check waiting for CRA at the end.
Yep, absolutely. Cool. You got one last question?
Yeah, you want the question on CPP?
Oh, is that the last one? Sure, let's talk about it. Let's finish her off.
Yeah, it's pretty high level. I get this one a lot on my social media. So, is it possible Canada will stop CPP because we'll be so damn broke? Word for word.
Yeah, and so we hear that from CPP, and we definitely hear that a lot on OAS as well. And for people listening, Canada Pension Plan, one of the best managed pensions in the world, consistently ranks as one of the top. I mean, you can look at the funding reports and see how well it's funded for, I think they go up to 75 plus years or whatever it is, but it's exceptionally well managed. So it's separated right from the federal government. A lot of people argue, they could just dip into it anytime. That's not how it works. It is separate. It's extremely well funded. And then when people look at old age security, they go, well, what if they just stop paying that or whatever, right? Or what if they lose all that money? That's just funded from regular tax revenue. And I forget what the number is, between 3 and 4 million Canadians that rely exclusively just on CPP and OAS to retire on. That's all they get, maybe some GIS. And so it would be absolute political suicide for some politician to come in and just say, no, we're going to cut out old age security, right? Because nobody's voting for that guy if, you've immediately just ostracized, 3-4 million potential voters. So,
and I mean, I can't remember how many years ago it was, they were considering bumping it up from age 65 to 67 on the OAS payments.
Yeah. Oh, on the OAS payments,
the minimum, and that caused like a huge uproar. So to completely eliminate it would be devastating.
Yeah.
the country.
Oh yeah, absolutely. I remember, in France I remember watching all the riots when they upped theirs from 65 to 67. And then obviously, Canada we upped, part of it too from 65 to 67, and then we went back to 65 on that one. But no, it's not something I think people need to be concerned about at all. It's not like Social Security in the U.S., which is not well funded. CPP is a very well funded pension.
Yeah, exactly. And we're looking at two separate entities here. I think people look at Canada's debt, Canada's deficit each year, and they're like, is that going to impact my CPP? And it's like, no, they're separate. You have this fund over here that's well invested, one of the best in the world, like you said.
Yeah, could have used some improvements. Always, they've been underpacing their benchmark more recently, but they're still well funded.
Yeah, that's it.
I'm always going to be critical though.
Yeah, can't be overzealous on it.
Yeah, right on. Well, thanks for joining me again. If you have any questions for Murph or myself, feel free to leave them in the comment, and we'll get to them on the next episode.
Perfect. Thanks again.